Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me for this segment, we have Kalish, Chief Global Macro Strategist at Ned Davis, to discuss the similarities and differences in the current tightening cycle and that of the 2006-07 period. Joe, it's great to have you with us. Welcome to Trade Talks.
Thanks, Jill. Good to be here.
You got it. And lately, we've seen bond yields rise. Could you explain what factors have contributed to these higher yields?
So, unlike what we saw last year, at the beginning of last year, where it was mostly the backup was due to inflation, 90% of the move since early April has been due to real yields. And the real yield drivers have been, first of all, growth, as people have pushed out their calls for recession into next year. Second has been supply. There's been a lot of supply that is scheduled to be issued. And I think that caught a lot of investors and traders off guard. And there's going to be a lot of supply coming in the future as well. And third is the fact that we've got competition from other central banks and other bond markets around the world. And even Japan, which has been a big supplier of capital, is likely to start to normalize its policy over the coming year. So this has really been about a move of real yields, and 90% of this move since April has been to the rise in real yields.
You recently published a paper that suggests the market might be underpricing the risk of additional rate hikes. Could you provide insight into why the market is behaving this way and how it could impact investor expectations and decisions?
Yeah, so first of all, the last guidance the Fed gave us was back in June. And back in June, they said that there was likely to be 2 rate hikes this year. We've seen 1. So there still leaves room for another one, yet the market continues to discount the fact that the Fed is done and that they're not going to have another rate hike. There's another couple of reasons here. So if you look back historically, we've looked back at 10 prior tightening cycles back into the 1960s. You'll see that 9 of those 10 tightening cycles, we saw the real Fed funds rate end, or that tightening cycle end, when the real Fed funds rate hit 2% or more. And so we're currently about 1.3%. And so that still gives us a little bit of room to go and for another rate hike. In terms of the expectations component, so if you look at maybe the market is sufficiently restrictive in terms of looking at inflation expectations and where Fed policy is, then you get closer to a 3%. The problem is we don't have a lot of history with that data, and inflation expectations can change. So there are some problems with that. But I think the market consistently has been expecting inflation to come down, growth to slow, and that just isn't what we've seen. We've seen some of the inflation come down, but certainly not to the levels that the Fed would expect and wants to see, and therefore we probably need to, I think the market is not giving the Fed enough credit for maybe adding another rate hike before the end of the year.
Yeah, it's interesting how none of these scenarios have materialized, certainly in 2023. Your recent paper also draws a parallel between the current tightening cycle and the 2006-07 period. What similarities and differences do you see between those two periods, and how might the lessons from 06 and 07 be relevant for the current market situation?
Yeah, so if you go back to and look at where we were first in terms of yields, the Fed funds rate got up to 5.25%, which is right where we are right now, in the 5.25% to 5.5% range. So that's one thing. The 10-year yield had gotten up to 5.25% as well in June of 06, when the Fed stopped raising rates. Now, if you look at the economic data, right after the Fed sort of stopped the tightening cycle in 06, we did see some modest slowing in GDP growth. Now, you can compare that to this cycle here, where we had a lot of that slowdown occur in the first half of last year. And then the economy has since then picked up, but the expectations have continued to be that the economy will slow down even as we go into next year. Now, inflation did come back, came down in 06. It's come down here, so That's very much in parallel. And the labor markets were extremely tight back then, and they're tight now. So, we saw very low unemployment rates back in 06, 07 time horizon. Now, there's another difference has to do with the shape of the yield curve. We were fairly flat back then, and as opposed to being deeply inverted this time, even though we've steepened somewhat in here, we're still deeply in negative territory. So I think the lesson and the key takeaway from that is that the market can come back, yields can come back to rise as they did in 07. And that was the real important point, is we got 10-year yields back to that 5.25% level. We came right back to where they are. And this is very reminiscent to where we were in October, where we got to 430 or so, and we're right back to those levels today. So the bond market can come back even if the Fed has stopped hiking rates. And I think that's the key takeaway.
And finally, with all eyes looking forward to Chair Powell's upcoming address at Jackson Hole, can you speak to what key topics or signals might you expect him to address in the speech, and how might this impact market sentiment and future monetary policy decisions?
Yeah, so I think we have to understand the topic this year is the structural shifts in the global economy, and I think that Chair Powell is going to start talk. He will, I think, talk about that. I mean, there are structural shifts in terms of what we've seen from the Russia-Ukraine war, and our political entanglement with China, and so this is reconfiguring some of the supply chains that we've seen. We've seen this greater emphasis on reshoring or nearshoring or friendshoring. So we may do more trade with other blocks and less with those blocks. There's been some commodity strains and shortages and at various times. We continue to see some supply constraints. We continue to be disrupted by weather events, likely due to climate change. Then you have tight labor markets around the world. You have shortage of housing in most of the developed world. So there are a number of factors here that could add to some upward pressure on inflation, and seeing how Chair Powell handles those structural forces will be of interest, because he has basically said we should go back to 2% inflation. And, the counter to that is, if we can't get there, then does the inflation target need to be higher? I don't think he's going to go there in this time. But the other thing really revolves around the so-called real run neutral rate, or the so-called R-star rate, which has been, the Fed's pegged at about 0.5% in most of their recent forecasts, projections. And that could also be higher as well, for the reasons that we talked about earlier. So again, I don't think he'll come out and say that they're going to, they need to expect a higher R-star, but I'll be certainly looking for any clues in that direction. And then finally, I don't think he's really going to give us any hints about the near-term direction of monetary policy. I think he'll be very consistent with what he's been saying, in that we're data dependent. There's a lot of data to come before the next meeting. There's no reason for him to tip his hand that the job is not finished. They're not down, and they can't see a 2% goal yet in sight. And they're going to remain restrictive for now. And so I think they'll keep that rate hike on the table. They'll keep with a tightening bias. And that'll be the message to the market, that we can't necessarily assume that the Fed is done and out of the picture.
All right, Joe, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.